Good evening. Good evening, everyone. So, first and foremost, I want to kick this off by talking briefly about Palantir. Not excitement about the stock going towards 20, or not anything about the long-term potential of the company, but more of a stark warning for most people. And what I mean by that is specifically talking around those that are following Palantir just to be in the stock because it's gone up over 150% within the past several months. For those of you that are only investing in the company because you're trying to ride a train and you don't actually understand the true value and underlying potential of this kind of organization, and it's not something that you've gotten into with the full due diligence, I recommend you either sell a portion, if not all, of your stock in Palantir today. Now, that is a very minute group of who I am talking to in terms of the broader spectrum of people that will probably listen to this. For those of you that do have your due diligence, that understand that it's probably going to be a 5 to 10 year journey with Palantir, it's a great time to celebrate. For those of you that don't know how to control your emotions, I hope you learn, because I'm sure if it doesn't happen this quarter, at some point there will be large pullbacks, 30, potentially 40% pullbacks, if not more, in the time it gets to where we honestly think, and I say we as a collective, Palantir will get to in the long term. And that would probably be, for my opinion, $250 billion. And I know some people on Twitter will probably clip that and call me a clown. And I get that. But anyway, hopefully that is useful for you guys. And hopefully it speaks to a very small portion of you guys. If you were strictly in it just for the trade, I caution you, because it will be volatile. And if you're not ready for that volatility, you might sell at the inopportune time. So quit while you're ahead, hedge your position a little bit. But for those of you guys that are on for the ride and understand it's going to be a roller coaster, welcome. And hopefully we see the continuation of 20s over the coming years. But I do feel like we will have a pullback here rather soon. Now, going towards what the true hope of today's discussion will be, which is, hey, I bought a shit ton of Enphase. I bought it all. No, I'm just kidding. But I think that it would be prudent for folks to kind of look at Enphase and understand and evaluate Enphase and understand how it compares to some of these other positions. I had somebody in the comment section, specifically when Chris and I were on, and I don't remember if it was the Google Cloud to Zero episode or the REIT episode that we had did on episode 2, specifically looking at how to value a REIT. But somebody in the comment section of one of those 2 videos asked specifically about how to value Google. And I respect that, because, I think that that is a good way to look at it. I think a lot of times people talk about the hype, the revenue growth, and you just got to have it in your portfolio. And first and foremost, let me just say one thing. I think we always talk about stock price, and you guys might hear me talk about market cap and all that stuff. And you're like, why is this guy talking about market cap? Because to be honest, stock price is only one thing. It's a byproduct of the market cap. And it's a byproduct of how many shares they have outstanding. And so if you have the same company, whether it's Apple or whether it's Tesla or what have you, and they just get rid of half the stock, then the share price is going to be a little bit different. So it just doesn't, like, I think that a lot of people don't understand that just because Palantir is a $20 stock now, that it's actually doubled the value of Enphase. Enphase is only a $20 billion company. And so even though Enphase is $150, technically it's cheaper than Palantir. And by cheaper, I mean in terms of total market cap. I don't necessarily mean from a valuation standpoint, although this might be a great lead into what we're talking about, which is understanding whether or not Enphase is a good buy. And to be very frank, I did some brief looking behind the scenes before I started talking about it today. And I was pleasantly surprised at how cheap it is. So I haven't really done too much due diligence because I have my money elsewhere, and I don't really have a lot of other money to put into a new position as of late. But to be very frank, it's opened my eyes taking a quick look, and so hopefully, for those of you guys that aren't necessarily on the Enphase train, um, I will put some caveats into here as well. The thing that kind of scares me is flat revenue over the past few quarters, but we can talk a little bit about that as well. I was pleasantly surprised at how much cash the company generates. I was pleasantly surprised at the net income of the company and the fact that it's only a $20 billion company. My thought process is basically, how much more run room does this company have? And that's something I just don't know. I haven't had a due diligence on. And sometimes that's the kind of due diligence you need to do in order to fully understand some of these companies and initiating a position. That's why I'm so comfortable investing in a Palantir when it barely was making any money, because I understood the long-term potential. But anyway, let's hop into the actual presentations here. So apologies, this is going to be like a streamception for a second. But what I basically want to do is look at Enphase. So let me just double check that this Enphase is going on. Yeah, Enphase is going on. So to give you guys a brief rundown, and maybe it's best if I just pull up Enphase really quick in terms of the stock price and everything like that. Enphase is a $150 company. In terms of the stock, sorry, $150 stock. The company's worth about $21 billion. And so this is the important number here. This price to earnings is also somewhat important. But keep in mind, let's just call it easy. The company is worth $20 billion. And so, taking it out of kind of like the whole stock price thing and everything like that, is it cheap, is expensive? First and foremost, let's look. It's a $20 billion company. So when you look at these things, and I'm not smart enough to go into these individual diffuser, God knows what sort of things. I'm not smart like that. That's a Vitaly and Carlos sort of thing, and the long-term trajectory of these. But where I do have a little bit more love and knowledge is the financial performance. And so you kind of see all these different cohorts, specifically looking at revenue by quarter. You have Q1, 2, 3, 4, and what you've kind of seen is 2022 is this light green. It's been 700 or so million, and then it goes into the blue for 2023 for the past 3 quarters, where generally it's going up on a pretty straight line. So the thing that initially catches my mind off bat is, why is this revenue kind of staying a little bit flat? But the thing that I then looked at, which was nice to see, was the gross margins are great of this company, and specifically somebody that sells kind of like a hardware and software. I know they kind of do both. But 45% is really good when you're selling an actual physical product. So that was kind of cool to see. And another thing, the operating expenses continues to kind of shrink generally, right? It's staying around the 12, 13% range. And then the income percentage is in the high 30s or mid 30s. So that's pretty good to see as well. So why does this actually all matter, right? So the thing that I kind of look at is, where's revenue growing? Is the company growing? Because let's just say it has a very rich valuation. Does that mean it's going to be trading for, and this might make sense in a few moments when I kind of run through everything, but when you have these growth companies, sometimes they trade at large multiples because they're growing so quickly. So while it might not be trading at a good valuation for this year, if it, say, grows 2 to 3 times within the next 5-year time period, it's okay to have a richer valuation because it's growing so quickly that people are buying the anticipation. And so then obviously if a company like an Enphase slows down very drastically, that's why it gets clobbered, sometimes 9%, 20%. So we see these high growth names and they get smacked and clobbered by 10 to 20%. That's the reason why. It's because people are kind of pricing in these large growth trajectories. And if they're not happening, they kind of have to readjust. Is it going from a 30% growth rate to a 20% growth rate to a 15? And that's the same debate that everyone has with Palantir too, right? At what point are we going to get to 5 billion in revenue? And, what's going to be the net income off of that? So diving into Enphase specifically, the first thing I kind of went down to check on was kind of the cash flow from operations, 269 million from this quarter alone, which if you multiply that by 4, you're getting about to $1 billion in cash flow from operations. Cash flow from operations, for those of you who don't really understand, it's basically your gross profit minus any sort of operating expenditures. So that's where you kind of get the 323 plus your operating expenditures, and kind of look at what the actual cash coming into the company was. Now, there's going to be some non-tax items, non-cash items, all that sort of stuff that kind of allows you to kind of have this 269 in terms of what you're pulling through. So that's kind of the thought process of how you kind of get this cash flow. And this cash flow can be used for capex, it could be used to buy back stock, it could be used to invest in the company, it could be used for dividends. And so a positive cash flow is a good thing, right? You can see just a few years ago, it was trading or churning out about $75 million a quarter. Now we're kind of over the past 3 quarters churning out $250 million a quarter, which is pretty good. And they're continuing to add to their balance sheet in terms of cash in hand. So they have about $1.8 billion in cash. So if you think at it from that perspective, sometimes people might subtract out the cash. How much are you actually paying for the company itself if it were to get liquidated? So it's like, okay, $20 billion company, take out the cash. It's an $18 billion kind of like cash, or what you'd basically be evaluating the company is $18 billion because you're taking out the cash. So then you say, well, it's $1 billion run rate, $18 billion in terms of leftover market cap that's not covered by cash. You kind of have a price to cash flow from operations of about 18, which a company like this, in a very niche market, it could trade anywhere, I'd say between 10, if you're kind of a high value sort of stock, anywhere to 40 times price to cash flow from operations if you're more of like a growth or very specialized sort of company. So it'd be trading at like a 18 to 20, depending on how you look at it, is pretty damn cheap, right? I would say, comparing it to some of the other companies on the market. And then if you kind of look at the non-GAAP numbers, it gets a little bit worse in terms of cash flow from operations. But I think net income ends up being pretty good. Where was that when I was looking at it earlier? So income from operations, this is where you kind of see it's just like, well, what is this? And the thing that I dislike almost about income from operations is like, of course, you have to include like taxes, how much stock-based compensation are you giving? So things like that to truly get you to a place where what is it truly being in cash flow from operations? So another thing. So this 326 is the gross profit, right? I might not have explained this well. You're probably saying, well, 153 million minus 328, you're more looking at like 180 something. Well, the share-based compensation isn't really cash, right? It's stock. So it's kind of a non-cash item. So in reality, the operating expenditures were really $98 million. So then if you kind of go back to here, that's where you can see the 323, subtracting out only like 100 million or so, that's where you get to the 269. So it kind of makes a little bit more sense as opposed to what I was kind of trying to explain a little bit earlier. But looking actually specifically on the income, so this is after tax, this is basically like net after you pay everything out, after you have the mark-to-market accounting, which mark-to-market means like, let's just say Enphase had some bonds or they had some stock in a different company, a SPAC, right? The SPAC thing was a big thing with Palantir, and all those SPACs went to zero. They'd have to write that off on their books. So while they have assets on their books, they're now worthless. And so they had to write that off. So even though from a non-cash perspective, they lost money, they still have to write it off on their books, and that would impact the net income. So that's why sometimes you'll see companies that have big write-offs of assets, whether it's a drug or whether it's an oil company writing off reserves. Even though they didn't technically lose money in terms of like cash, they had an asset that they thought was valuable and had it on their balance sheet that then disappeared. And so that's why you'll see some companies, a lot of companies in 2020 and 2021 wrote down a lot of reserves because they started to have to look at, for oil companies, because they started to have to look at their forward pricing. And at the time when oil prices went negative, everyone thought prices were going to stay in the 60s and 70s. But that's a different story for a different day. So then taking a look at the $20 billion sort of market cap for Enphase, and then saying, okay, well, let's just say you're able to keep this 225-ish net income per quarter going. So that gets you around, let's just say 900 million. You'd be looking at a $20 billion market cap divided by 900 million. You'd be at a 22 times price to earnings. Then you have to say to yourself, like, how does that make me feel, right? 22 price to earnings isn't really that richly valued, right? When you look at like the historic, some people might say for value companies or the S&P 500 as a whole, 15x. And what a 15x is basically it's going to take you 15 years to realize that earnings for your business to kind of break even, right? And so that's kind of the thought process of like what a 22 would be, right? You're making $900 million a year. You're paying $20 billion for the company. Over that long time period, you'll eventually get to the point where your earnings meet that. And it's kind of just a valuation metric that you can use to then go say, well, this company is cheaper than that company. But this is where the nuance comes in. This is where it's tricky when it comes to this thing, because some people might say, wow, okay, Enphase is trading at a 22 price to earnings, but let's just say a Google's trading at an 18. It's like, well, Enphase, let's just say, you'd say is more expensive at a 22 price to earnings versus an 18 on Google or something of the like, or a Palantir, which is much higher. But that's when it can get subjective, right? Where do you see the company going? Is Enphase going to double revenue next year? Because then in reality, it's like, okay, you might be paying for a price to earnings of 22 today, but next year's earnings, you're paying for a forward PE of 11 because the earnings have doubled. It went from 900 million and you're expecting 1.8 billion, let's just say, for fiscal year 24. So then it gets back to, what are you paying for? Are you paying for what the price is today? Or what the price is next year, or what it's going to produce in 2025. And then you start to think, it's like, well, how much trust do I have? How much conviction do I have? And that's when the due diligence piece kind of really adds up into, am I buying the right opportunity, right? Because you might be sitting here being like, well, Palantir's trading at a PE way higher than 22. We have to realize what market and what's the total addressable market for what these companies are invested in. So if you're looking specifically on the modules that would be able to go on to a solar panel, how much, like the whole energy total addressable market is going to be in the $8 to $10 trillion total addressable market. But how much of this component will be part of that $8 to $10 trillion market versus what Palantir is going to be, which is a $1 trillion market, or maybe $2 trillion, depending on what markets you add up together. And are they going to be able to capture a whole percentage point, multiple percentage points of that entire market? So that's where you're starting to understand, like, okay, this is how you combine the price to earnings ratio versus future growth. And that may or may not be useful for you. Maybe what you care about more is how quickly is the revenue growing and how much of a market share do they hold. And that's when it starts to get really, really intense, because certain companies, certain metrics matter. Like we talked on last week on Wednesday about REITs, where price to earnings doesn't really matter for REITs because you have so much depreciable income from just depreciation of real estate, where you buy a commercial building, you can depreciate it over 39 and a half years. You buy a single family home, you can depreciate it over slightly less than 30 years. And so all that depreciation is basically lowering your net income so that you don't have to pay as much taxes. It's a benefit that the government gives you to continue to invest in real estate. Oil and gas, they give you depletion, which is basically how much have you put in terms of capital into producing this asset. And for every barrel you produce, you get to write off a portion of that cost. So that way you're not getting like massive taxes on absolutely everything. You're able to assume, hey, we spent $1 billion investing into this. Let's get some tax cuts on it. And that's the incentive of depletion, depreciation, amortization. And so when you hear those things, it allows you to kind of write off. And then you do straight line, you can do accelerated, a bunch of different things with this associated with that. But the hope is that you can look at or start to understand where things are kind of coming from a gross profit perspective, net income perspective, EBITDA perspective. EBITDA is kind of like this gross profit generally. So if you start to understand and understand how to evaluate things, certain companies will have higher capex. So, for instance, this cash flow from operations, I don't anticipate Enphase having a large capex budget. They might if they start acquiring companies or something like that. But if you're an oil and gas company, a lot of your capex goes back into the ground. Um, so you're always trying to reinvest to continue oil production going through because there's decline in oil production. And just like real estate, right? Your assets depreciate over time. So you can't just like buy a house and sit on it for 40 years. Eventually the useful life of that house is going to be, you're going to have to put some capital into it to keep it up, redo the walls, redo the bricks, the wall fell down, the bathroom blew up, like all those sorts of things that you have to kind of fix and upkeep. And so there's tax benefits associated with it. So that probably beats Enphase to almost death. So no, I didn't actually buy the company, but I did just want to kind of look, and I was pleasantly surprised that on a net income basis, it's not trading all too bad. The price to earnings um, does get a little bit scary, but on a cash flow from operations perspective, it's not trading all too bad. Um, but anyway, I'm just kind of curious how that's going to go. And the one caveat I will say with Enphase, um, if this were to dip pretty extensively, I might consider. The thing that scares me though is going back to the revenues. Revenue staying flat a little bit, and I think that's why the stock went down a little bit earlier this quarter, or after the Q2 report rather. And that's because generally, even through Q2, you'll see a little bit of growth, at least from what I've seen. Q1 to Q2 in 2021, you saw a little bit of growth. Here, you're actually seeing a little bit of anemic growth. And generally, from what the past few years have shown, you'll always have a little bit of growth going from Q4 to Q1, and you saw very minimal, almost flat growth going in from Q4 22 to Q1 23, and you're actually starting to see anemic growth in Q2. And so you went from this pretty decent growth rate to now kind of declining. And so where does that stabilize? Does it flatline and then eventually the market kind of sorts itself out? Interest rates kind of get self sorted out. And Vitali and Carlos did a really good job explaining this the other day. So I don't want to take away or devalue what they said. But, with interest rates going back down, is this going to go up? Is there going to be more incentives with the Inflation Reduction Act or the Infrastructure Act to help out people with respect to individual solar systems, where Enphase would see a reacceleration in some of that growth? It's that kind of puts into how expensive is that price to earnings that you're kind of seeing, or the price to cash flow from operations of like 22. If you're saying, oh well, the cash flow from operations, that 22 doesn't seem too bad. Well, next thing you know, if that starts declining because interest rates and people aren't going out and putting in as much money into their individual solar systems, and next thing you know, it goes from 900 million in cash flow from operations to 500 million, then you went from a 22 price to cash flow from operations to a 40p to cash flow from operations. And you start saying there, it's like, well, would you want to pay a 40 for a company that's in anemic growth? I don't know, right? But does it kind of reaccelerate again? And so that's where the detailed orientedness kind of comes into looking at some of these companies. Now, let me just double check. Man, these guys are still on. Jeez, good for them. So getting into specifically the NextEra Energy. So those of you guys that don't really know about NextEra, they are a basically a renewables company. It's one of the largest renewables energy companies within the United States. And so they're focusing on getting a large amount of gigawatts in operation. I think right now for renewables, they have about 28 or 29 gigawatts in operation. And you'll see in this presentation, if you pull it up, that they're going to try to grow that by about 41 or so. And through this presentation, it shows a lot of cool information. This is the kind of the investor presentation. It's not necessarily the Q2 earnings, but it kind of shows you a little bit about how market prices for energy has increased here, increased there, and it all kind of depends on gas prices and what have you, and what the Inflation Reduction Act has done for wind and solar going forward. And it shows you a little bit about their portfolio. What I don't really want to do is go into specifically, NextEra Energy or anything like that. But I think this one's a really good thing to keep in mind, specifically for those that might be interested in renewables, and also just from a price to earnings kind of perspective, and what you're kind of looking at here. So to put it in perspective, I think NextEra is about $140 billion company. Let's see. Yep, $150 billion company. Sorry. Currently trades at a price to earnings of about 18. So let's just do some quick mental math. Let's just say 150 divided by 18. They're making about $8 billion a year. It's kind of the thought of this. Company has been doing really well in the long term, up about 1,200% since 2000. So that's a pretty good run rate on an annualized basis. And this was kind of what I was talking to. So this is a company that will continue to grow revenues going forward very extensively. They have a lot of things in the pipeline that they're continuing to invest in. And so this is an interesting one to look at. So in terms of renewable energy resources, they have about 28 renewables installed, and they're trying to get to 69 and 420. So the thought with that is specifically how much is that going to actually grow the EPS? But for right now, what we can look at is kind of the earnings per share. And we know for a fact, just based off of the share price, you're at about 73. So 148 divided by 73. So you're about 2 billion shares, if you think about it. Because if you double the 73, you get to about 146. So that's close enough. So about 2 billion shares. So then if you think about this, you're kind of aiming for about a $3 earnings per share. So in that respect, you're looking at $3 times 2 billion. You're looking at about a six in terms of the $6 billion in terms of actual earnings. So looking at this, you're going to go from, let's just call it 3 in 2023, which I don't know why it says a price to earnings of 18. Makes me think that there was like an outrageous quarter last quarter or something like that, and it's not being fully factored in. And then let's just call it $3.75 in 2026. So let's reduce this down to the 150 divided by 6, because that's kind of what they have in their presentation. That gives you a price to earnings of about 25. Now, if you factor in the growth that we were kind of talking about earlier, and you go to 375 per share, so we know 375 per share. We know that there's 2 billion shares outstanding. It gets you to about a $7.5 billion net income. So if we know for a fact, this is where you can start to play a lot of games and stuff like that. What you can say then is you have a $150 billion company divided by, the new $3.75 EPS. You go from a fiscal year 23 price to earnings of about 25 to a fiscal year 2026 of about 20. Now you're sitting there saying, is that too expensive? Is that not expensive? You start to try to understand, how much do I trust this, right? Because next thing you know, just like what we saw with with Enphase, maybe it flatlines at 3. And then here you are sitting at something within 3 years, you have these unforeseen expenses where you're getting to an EPS of 3 in 3-4 years time. You're saying, here I was paying for something where I thought it was going to be a great company growing at 6 to 8% per year in terms of earning per share. And now it's just sitting at where I was expecting it 3 years ago, and it hasn't grown at all. And you're sitting at a price to earnings of 25 still. And you're like, well, I didn't actually get the growth that I wanted. So what would I have actually paid? Would I have paid 20% less, instead of 70 something dollars a share? Would I have paid $60 a share to be able to accommodate for that? But it all depends on, what if this actually was a $5 earnings rather than what we're seeing. So if, say, we were to go to $5 earnings per share, $5 times 2 billion shares, you're $10 billion in net income. We know we're paying about $150 billion for the company today, divided by $10 billion in net income. You have a price to earnings of about 15. That's pretty good, right? If you were to anticipate that the company might be trading at a PE of 15, and renewables are going to be there, right? They're going to continue to be that, and they're continuing to lower in terms of costs to put online. They're continuing to be worked, like wind and solar is continuing to get cheaper and cheaper per megawatt that they install. So that's a way to kind of understand, how to evaluate a specific company. But this goes back to what I was talking about with the real estate investment trust. It's like, what's important to evaluating Nextera? What's important to evaluating Enphase? What's important to evaluating Google? And you kind of get stuck between this rock and a hard place because there's so many different ways to evaluate a company. Are you evaluating it on net income? Are you evaluating it off of, the price to EBITDA? Are you evaluating off of price to book ratio? Because with all this, for example, let's take a good example. Banks, generally speaking, a good time to make an investment in a bank is when the price to book ratio is less than 1. If you feel comfortable that that particular asset is trading at, let's just say, good valuations for those assets. So if you are sitting there saying, well, the price to book for Wells Fargo, let's just take, for example, I don't know what it is today, but back during the pandemic, I was buying Wells Fargo at 0.6 or 0.7 price to book ratio. So that means 70 cents on the dollar. Like if they were to eliminate all the liabilities, eliminate and sell all the assets, it would have been worth, let's just say, $100 billion, but the stock was trading at $70. And so you're paying $70 for that, or sorry, 70 billion. You're paying 70 billion for that. In reality, it's worth 100 billion. If they were to liquidate the company today, you'd walk away with that 100 billion and you paid $70 billion for it. So in that case, it's a net positive. But this is where it gets a little tricky, right? Because sometimes some of these assets, just like I was telling you earlier about write-downs, some of those assets might be worthless, right? And this is kind of what happened during the great financial crisis. Certain people had assets on their books. They were rated hundreds of millions of dollars. Those hundreds of millions of dollars were actually worthless, right? So something might have been valued to something on the books in reality. And this is where it gets to like credit loss provisions and stuff like that, where you're assuming these things might go belly up. Let me put that in the books so that if it does show up, we kind of already have written it off to an extent. And so you saw a lot of that during the pandemic. You're starting to see that a little bit over the past few months with what's been going on with banks, where they're devaluing some of these assets. So that way it hits their price to book. So that way you can kind of get a better idea as to, are these real price to books or does it need to be adjusted still? And it gives you a little bit of an idea. And so there's a multitude of different ways to evaluate a company. But I think the thing that I wanted to kind of show you most is kind of the most traditional. But like I said, not every company makes income, right? So how do you evaluate a Palantir? How do you evaluate a Snapchat before it starts, creating cash? It's difficult. You kind of, like I said, have to understand what's the market share of the organization. Where do you see it going? What do you think it'll eventually kind of create? A lot of people thought, initially, just like me, I got fooled by Facebook. I bought a few shares of Facebook in the 70s. I had like 20 shares. This is back when, $3,200 was a lot of money for me. It's like $70 a share, had 32 shares or whatever, 20 shares or whatever. So it ended up being like $3,200. And after a couple months, I was just like, this company doesn't make any money. Like, why am I owning it? And I sold it. Right. Well, that was, I don't know if they did a split or not. I feel like Facebook did a split, didn't it? Maybe it didn't, but I sold it back then, and who's the idiot now, right? So, yeah, I think it gets you to sort of think about things to an extent. What sort of long-term addressable market that some of these companies are put into? Because let's just be frank, if a company is in a $10 billion total addressable market, and they're like, we want to capture 20% of this total addressable market. Well, the revenue is only going to be $2 billion a year. So it's like, okay, well, here they are, 20% market share this $10 billion market, and this market's not growing at all. In fact, it's anemic growth. Then here you are paying money to invest in a company that, maybe it's a cash flow king. Maybe they're taking any excess money and they're buying back the stock and stuff like that. Who knows? That could be a very much a way to make money. And I think that's a good, I actually thought about doing that video today, specifically talking about a company that has 40, 50x'd over the past, like, I don't know how long it's been, 20, 30 years. I forget. It's a really good case study that I've done in the past that I'll bring up to you guys, where it's 40, 50x, and you're sitting there like, the earnings have only gone up 7x. So how's the stock? Like, is the stock 7 times more expensive than it was back then? In terms of like going from a price to earnings of 10 to a price to earnings of 70? And the answer was no. They used share buybacks to help, eliminate some of the float. And so you're able to go from a 7x to a 35, 40x very quickly because they bought back 80% of the shares outstanding. So you start to understand, how the actual stock price sort of works comparatively to the market cap, compared to the shares outstanding. If you dilute the amount of shares, you're giving it all to employees. That's why some people get angry about Palantir or Snowflake, because they're giving away hundreds of millions of dollars every quarter in terms of share-based compensation. You're saying basically, well, we had 2 billion shares. Now we got 2.1 billion shares. So if the market cap was 40 billion, now you're looking at a share price of $19 versus $20 because it was 2 billion shares. Now it's 2.1. You have to take away 5% of the value of the stock because there's 5% more shares. So just a little bit of a hope that finds you guys well. I'm going to glance through some of this and see what you guys have to say. And then I might just cut it. But I know that we were kind of, they're still going, dude. They're still talking. So hopefully you guys catch this afterwards. But yeah, let me see. Thanks for wisdom. Thanks, man. Market cap is really attractive. I agree, but is it going to continue to grow as a company? That's the real question. Yeah, I acquired the entirety of Enphase. Much appreciated. How much the company, think how much higher aluminum or copper prices in the future could have a negative impact? I'm sure it does, but based off of what I was seeing in terms of, specifically this aluminum and copper prices, I'm sure it does, but just based off what I was looking at in terms of the margins that they get, I'm sure they'll be okay. It might take 5% or so off the margin, but the thing that's really going to be a driver for me is how much are they going to continue to grow in revenue? Like, you could sit here and debate, 5, 10% of their margin might go away due to aluminum or copper prices, but if they're able to expand revenue by 30, 40% again, then, it's kind of a moot point, right? Because it fully offsets that issue. So I like it, Rocket Lab. I like Rocket Lab more as well, personally. I did not actually buy Enphase, so apologies for those of you that I clickbaited. Keep it in a buy range. Yes and no. I mean, what if it stays flat forever? This is the part where I don't know, right? That's just me not having familiarity with the company. And that's where I would kind of lean to Vitaly or Carlos to kind of give me that conviction that revenue would be kickstarted again, because flat for 3 quarters in a growing company, that warrants a 20, depending on how you evaluate companies. Some people like to evaluate on price to earnings. Some people like to value on cash flow. I like cash flow personally because that's it takes away all the non-cash items. So price to cash flow from operations being about a 20x, I don't think that's that big of a deal. Anything bullish for Enphase in the next 3 months? Absolutely nothing. I would buy the dip and not buy now. I'm with you there, man. I think I would wait for a little bit of revenue kickstart before I truly made a sizable move into the company. That scares me a little bit, specifically about how much, I'm not talking crap or anything on Vitaly. I appreciate everything they bring to the community, and Carlos as well. That scares me, like the flat revenue. So, I mean, if the same thing happened in Palantir, I'm sure people would lose their effing minds. So Appreciate that. Informative. I really appreciate that. Did you talk about the effects of interest rates in the solar industry? I did. I talked a little bit about the Inflation Reduction Act as well, and the Infrastructure Act a little bit to an extent. How much did I buy? I didn't. I clickbaited you. I apologize. Yeah, Amit's beating a dead horse. He likes to talk himself in circles. That's why I created a separate show, because he refused to ever bring me on. That's a bad joke. Amit and I are great friends. We were chit-chatting about life and how to continue to add value to the community last night. So I had to ask him for permission to say that Palantir was dead. Palantir Weekly was dead, which is a lie, by the way. So hopefully you guys don't believe that. Yeah, dude, he's still alive. He's out of control. Yield Max, I wish you the best, my guy. So hopefully Yield Max continues to do well for you. So this gentleman's making $17.50 off of TSLY alone. Each month is different. So hopefully with the covered call ETFs there, it continues to do well for you. But yeah, no, you appreciate everybody stopping by. But 26 of you guys in here. Yeah, it's fun to watch Amit grow and learn. I just hope that he doesn't get too involved in the hype, right? Because I think young investors are very influenced by recency bias. And well, I think he does a good job to an extent. I just don't want him to be, how do I say this? I don't want him to, what happened to a lot of friends in 2021 was they, and myself is included, got caught up a little bit in the hype. And I'm an more experienced investor, got caught up in the hype and got burned pretty badly. So while 2020 to 2021, I like triple X'd my money, went from like 400 or so to the over 7-figure range by 2021. I saw a lot of that come back in 2022, and I spent a lot of 2022 and early 2023 climbing back to that 7-figure mark. So just kind of glad that he's kind of getting involved early, and I hope he listens a lot to Chris and Carlos and Vitaly, because they all have a lot of experience throughout them. So hopefully he doesn't let it go in one ear and out the other, and he listens to some of them. I fear that the fear is you have to acknowledge and have separate accounts like Chris does, some that are long-term focused, some that are very short-term focused. And you have to understand, what game you're playing, because I've been burned in the past as well. And when the market's going crazy like it is now, it's very easy to add Enphase. It's very easy to add C3 AI and expand the amount of positions in your portfolio. And so I just hope you recognize it's like during times like this, it's good to consolidate. What companies do you actually want to hold in terms of conviction and double down on some of those? You might make the wrong decision, but sometimes we buy positions just because the stock price goes up. And I have a lot of friends that did that in 2021. All right. Well, I just did this to keep the fun alive, keep things going. I have a clip or two to kind of clip from here to share with folks. So hopefully I get around to that. But I just wanted to make sure that we don't lose the cadence. And I plan on having Chris back tomorrow. So hopefully he enjoyed his vacation with the missus. And as always, we listen to you guys and want to bring you guys any sort of value you see, whether or not it's something you have a question on, or if you don't understand something, or if I misspoke, feel free to talk in the comments section. I try to keep up with it all. And that's really it for tonight. So appreciate we didn't have a large enough audience as I expected. I know Amit's still going, so I'm going to hop back over to that. And I'll see you guys tomorrow with Hot Chris Patel. All right. Thank you guys. Cheers.